Welcome to the Education of a Financial Planner, where we look at the major concepts in financial planning through the lens of two quant investors who are learning the ropes of the planning process and how to help clients achieve their long-term goals. Learn along with us as experienced financial planner Matt Ziegler helps us understand the most important financial planning concepts that impact all of us and how we can apply them to achieve the best outcomes in our financial lives. In each episode, we will work through one major financial planning concept from the ground up and learn how we can apply it in the real world. From retirement to college savings to taxes to estate planning, we will cover a wide range of topics that apply to each of our everyday lives. We hope you will join us in our learning journey.
Justin Carbonneau and Jack Forehand are principals at VALIDEA Capital Management. Matt Ziegler is managing director at SUNPOINTE Investments. The opinions expressed in this podcast do not necessarily reflect the opinions of VALIDEA Capital or SUNPOINTE Investments. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of VALIDEA Capital or SUNPOINTE Investment.
All right. What we're going to do today is build off, to some extent, the discussion we had a few weeks ago around momentum. So what we talked about then, and we'll kind of get into some of this too today, but we sort of talked about momentum, the way it can be used to build investment strategies, some of the pluses and minuses of momentum investing. And what we thought we'd do with this discussion is kind of bring it, I guess, one level down and talk about how value investors or different types of investors can use momentum to augment their investment strategies. And, they're two very different styles of investing, value and momentum, but because they're so different, and we'll talk about this, that, when combined or when utilized in different ways, it can sort of help smooth out the returns of an investment strategy over time. And so that's going to be sort of the goal of this discussion, to talk about how value strategies and momentums can utilize momentum. But first, let's just kind of spend the first couple minutes here just as a recap. Let's define what momentum investing is and what goes into that.
Well, first of all, I'm obviously going to ramble on with some dry factor-based analysis in this, but just for give people something to look forward to, apparently Matt is going to use the musical catalog of the Great Limp Bizkit in this episode to help us understand momentum. So I'm really hoping I did it all for the Nookie is coming on, but I don't know how he possibly could get that in there. But Matt, I'm looking forward to whatever you might have coming here later.
I promise to take you in a direction that avoids as much Fred Durst as possible.
By the way, the listeners are liking these musical references. We are getting comments, and the feedback has been good. So we got to.
Wasn't the comment was that we embraced the cringe or something like that? It was something like that, right?
Yeah, it was. It might have been my singing effort, but whatever.
Well, it's good. At least we're different than other people talking about factor investing on podcasts. But anyway, back to your, now that I've digressed off of that, back to your question. So momentum is basically just buying things because it's gone up. And, we're not going to go into tons of detail here because we did in our other episode. But one of the cool things about momentum is pretty much anyone can use it. Because if you think about it, if it's just buying things that have gone up, well, how many things out there are there that are like publicly traded, that have prices that move up and down? I mean, there's tons and tons of things. There's asset classes, there's stocks, there's all kinds of the bond and anything basically that's trading, you can use momentum. And so that's kind of a very cool thing. And that's sort of what we're going to talk about today, because people who are value investors might say, well, I'm not going to use momentum. Why would I use momentum? And the key is there's various degrees to which you can use momentum. There's a very aggressive degree to which you can use momentum. And then there's ways you can use momentum around the edges. And if I'm a value investor, and even if I'm like a person who believes really strongly in value and doesn't like momentum, there's still things I can do around the edges that'll probably make my portfolio better and more efficient by using momentum. So that's kind of what we're going to cover today.
And like I think talked about last time, the reason that momentum, I guess, tends to work, it's kind of, I think, a little bit more stronger in the behavioral, I guess, camp with, possible underreaction by investors to good news. So it takes time for investors to, accept or acknowledge the news. And so there's sort of like a delay in terms of investors' reaction, but ultimately, investors come in and there can also be like a herding effect. So there's like an under and overreaction, I guess, rationale for why momentum works.
Momentum as the underreaction to good news, just like value is trying to capitalize on the overreaction to bad news. And that pervasive underreaction to good news is something that carries something higher, it's such a powerful visual metaphor, I think, for understanding why this thing exists and why we see it everywhere.
And to my point, it can happen anywhere. Like there can be an underreaction to good news in commodities. Most people think about it with respect to stocks, but it can occur anywhere. And that's what's the cool thing about it is, that effect works, across everything. And so it makes it a really great tool for investors to use in their portfolios in many different ways.
One of the challenges of momentum, though, is it can be susceptible to these like crashes. First of all, it's tough in transitionary periods when you have a certain asset class or certain groups of stocks that's underperforming and then that turns on a dime. Momentum takes time to get back in, but then you can also have sort of higher volatility or more risk of momentum crashing when sort of the trend sort of dies down.
And that's why the all-in momentum approach is not great for a lot of people. Like, we talked about in our other episode, a lot of people don't love momentum because they don't understand why it works. They don't understand, like they want to know something about the value of a business or its earnings growth or its valuation, its quality, something like that. They don't want to just say, I'm buying something because it went up. And so that can make it hard for people who are like value investors to use. And so when you have those crashes, when you have those periods it's not working, if that belief is not there, you're going to abandon it, which is why in a lot of cases, using momentum around the edges is a better approach. Because if I use momentum around the edges, I'm a lot less subject to those types of things. I'm using it like, and we'll talk about what those methods to use it around the edges are in a little while. But if I'm using those, I'm not as susceptible to a massive issue with momentum that's going to cause me to make a behavioral error.
I think in the underreaction to good news, it's that underreaction, but it's not going to be just getting better forever. And I'm gonna beat you to Limp Bizkit first on this one, because this is like, it's the break stuff thing for like whatever model you have. So if you want to go momentum, and this is why a lot of professional allocators don't like to use it as a standalone all-in strategy, because eventually, like, what's the trend is your friend until the bend at the end thing that the technical people like to say? It's this whole thing. Like sooner or later, Fred Durst shows up, he's going to break stuff. And that thing that's been working so well and so cool is just going to explode in volatility to the downside. And that's always in your future when you're a momentum investor.
And by the way, we'll get into sort of, I guess, why value investors struggle with this, but that might even be true of all different factors, Matt. There's
every strategy, Fred Durst is coming for you eventually when stuff is going well.
There's that chart that we often reference by Larry Swedroe, who we just had on the podcast earlier this week, talking about his personal investing strategy. But he has that factor chart that shows over 1, 3, 5, 10, and 20-year periods, all the different percentage of time that a factor underperforms. That's not necessarily talking about crashes, but whether it's value, momentum, all those different factors, over different periods of time, there's always chances of relative underperformance. What's interesting is that, and this was from, one of his books, I think the Factor Investing book, but what is interesting with momentum is when you look at it over both a 10 and 20-year period, the momentum factor has the least amount of percentage time that it underperforms the market. So over 10-year periods, it only underperforms 3% of the time. Over 20-year periods, it doesn't ever underperform, whereas value actually underperforms 6% of the time. I know we're kind of getting into sort of some numbers and details that might be a little bit detailed here. Maybe we can throw that chart in if we want, but
we'll have to dig that.
Yeah.
We'll have to dig that up, but that what you said is so important, because that's the opposite of what most people would think. Like if you said like, what's a more consistent strategy over those rolling 5, 10-year periods, most people would think it's value. It's not. Momentum is actually a more consistent strategy over those periods, which is, people think momentum, risky, stuff, high flying stuff. And it's not the case. So we'll put the chart up there because that sort of gets into what we're going to talk about in a little bit, which is as a value investor, if momentum is a completely different return stream, it works in different times and it's more consistent, I'm going to benefit from using that. Now, I might not like it. I might not believe in it as much, but like I'm going to benefit from that. Like the combination of value and momentum is better than value on its own. I mean, it's very, very hard to argue anything against that. So it is important as a value investor to sort of open your eyes to some of this data and say, this is a really strong factor. It has really strong evidence supporting it. It's more consistent than value. There's a lot of reasons you might want to use this.
I think one of the reasons that, value investors struggle with this is because what do value investors do? They start with the financial statements, the income statement, the balance sheets, the cash flow, the quality of the company to some extent. A lot of value investors are looking for cheap stocks based on some type of metric, or maybe the intrinsic, trying to buy stocks below their intrinsic value, where momentum investors, don't care. If you're a pure momentum investor, you don't care about any of that. All you care about is what's going up or what's going down, what to get in and what to get out of based on momentum. So, I think that's where a lot of value investors just can't wrap, and it's for good reason, because they're completely different ways to select stocks or asset classes, or to try to find, where there's opportunity in the markets.
Yeah, that's an interesting point. One of the strategies we run has this fundamental of momentum overlay on top of momentum. And I think to some degree for like a value investor, something like that might make a little more sense. Because if you have that belief in fundamentals, it's not valuation you're worried about there, but if you have that belief in fundamentals, like seeing the fundamentals have momentum as well, and not just the price. And, the pure momentum guys will argue you're not adding anything with that because it's sort of reflected in the price already. But still, as a belief, we always talk about it. It all comes back to your belief as an investor in what you're doing. Like, I think if value investors do think about, if they're taking a more integrated approach, which we'll talk about in a little bit, adding that fundamental momentum with the price momentum may make a lot of sense, because again, it gives you a better chance to believe what's going on because you're seeing actual numbers on the companies.
I think anytime you're mixing in these, like, we're just using statistical tools. And that was one thing some prior colleagues and people I used to read a lot of stuff from at Bank of America Merrill Lynch, the like Nigel Tupper and Savita Subramanian, that like earnings betas and earnings momentum and all sorts of things that fundamental investors we talk about. And value investors might feel like, oh, you shouldn't just be looking at the price and ignoring all this stuff. But these are just statistical tools. And if we're telling you that human behavior means these things are pervasive and they exist everywhere you look for them, you can figure out which place you want to train this statistical tool on to help you in your process. And I think that's a constant of just learning the language of momentum that's really important.
One of the ways that some of our strategies utilizes, and I don't think I'm jumping ahead here, but I'm just making this point because one of the ways that sort of momentum can be used is you can create like a screen. You could like create a value screen, let's say, and then as the last sort. So let's say you create a screen of low PE stocks, and maybe there's some other metrics in there, and then you have a list of 150 names. Well, that's probably too big of a portfolio to buy, but you need some final last sort to get that list down to a more manageable set of names. You could basically then rank on relative strength or intermediate term momentum, 12-1 momentum, to get maybe the top 30 names for the portfolio. And actually, that's what many of the strategies, or at least a few of the strategies on VALIDEA that utilize momentum, they do this like last final rank of using momentum, because it's the way that gets the list down to a more manageable list of names. But also those are the stocks that are likely in the list to put up the best, intermediate term performance, because momentum is such a strong indicator of that type of performance period.
Yeah, no, I think that's great. And that's a problem we face all the time. Like, we'll have a strategy we run and there'll be, say, 60 stocks that all have the same score from the strategy, and we only want a 30 stock portfolio. How do we get there? Like, there's all kinds of different ways you can do that. And, we've looked at like, using like a consensus score that we have from all of our models to do it. You could use momentum as a great thing you could use there. You could use something about that model itself to try to do it. So there's a million different ways you can do that. And one of the good ways, especially with a value strategy, is momentum, because they are complementary to each other. So, you're going to avoid, if that last sort is momentum, you're going to avoid some of those companies that might have some significant problems that maybe you're missing by just looking at financial statements.
That's a good point, Jack. And let's continue to kind of build on. So there's that way you can use momentum. And there's also a number of other ways that value investors might consider using momentum. And so I think, let's start with the, equal weight value in a multi-factor portfolio.
Yeah, this is the one probably value investors are going to be most reluctant to do. It probably is the best one if you look at the data, but they're going to be most reluctant to do it. I think I called it, like in my article about this, the full Monty. It's basically like the aggressive implementation of momentum. It's like the recognition that value and momentum are equally good factors, So why don't I use them basically like half and half in my portfolio? And there's two different ways you can do that. One is the sleeve method, one which is where you basically have your value portfolio, you build a separate momentum portfolio, you put them together into your overall portfolio. So that's one way you can do it. The other way we call like the consensus method, which is you can say, I can find stocks that have both value and momentum simultaneously, and I can use that to build my portfolio. The issue to some degree with that is, you're looking at, as you look for more and more momentum, a lot of the time you're going to get less and less value. So if you're a pure value investor, you're looking at your whatever you're using, your PE ratio or whatever. As you add in that momentum, your PE ratio on your portfolio is probably getting higher. You're probably like sweating and getting less comfortable with what's going on. But I think that is the best way. I mean, for someone who's building a factor portfolio, relying purely on value, and we've learned this in the past, couple decades, may not be the greatest idea. So the best thing is you've got something whose excess return is uncorrelated, put it in there, use both of them equally, and build a portfolio that way. But I say that recognizing that many value investors aren't going to do that because their belief is in value and not in momentum.
So let's think about the last 2 years with those different methods. Let's first talk about the sleeve method. So in 2022, at the beginning of the year, you would have probably, if you were using a momentum strategy, you probably would have been mostly allocated to large cap tech because that was what was working at the end of 2021. And then you would have been, I think the value type of stocks would have been, energy, just the stuff that was cheap. Now in 2022, the momentum sleeve would have probably done poorly because all that growth stuff got hit really hard, but the value stuff would have held up. So that's an example of where that type of strategy would have, how those sleeves would have done. Now turn that into this year. It's kind of been the complete opposite up until like a month ago. Like your momentum sleeve would have been doing really well and the value sleeve would have been underperforming pretty significantly. I think if you take the consensus method and try to think about the types of stocks that would be in there, you probably, because you're sort of blending those two factors together, you're not getting as pure factor exposure. So I would tend to guess there'd be more like of a quality component. Actually, I think maybe in that consensus method to some extent. And I don't know exactly. I think that would have been a middle of the road strategy for 2022. I think in 2023, actually quality stocks have done pretty well. So I'm just trying to think of, the last few years and every market's different. And so then that's the one thing with momentum is you can have momentum in a lot of different types of stocks all throughout the market cycle. Whereas kind of value generally tends to stay, in certain sectors and areas of the market, kind of for the most part, not always, but mostly. So I don't know if you guys have any thoughts on that.
Yeah, well, this gets at that idea that momentum's a chameleon. So if I take a momentum portfolio and I score it based on value, quality, low volatility, the other metrics, and I look at that over time, it's going to be all over the place. Sometimes it's going to be all in on one. Sometimes it's going to have some exposure to all of it. It's just going to be all over the place. And what you were talking about gets at that idea, because if you had a sleeve, if you had 10 value stocks and 10 momentum stocks, there at that period you talked about, there was going to be a point where those were very, very different portfolios. There was also going to be a point where you basically had a 20 stock value portfolio because value was doing so well that momentum had jumped all in on value. And so that's like something you have to understand with momentum, because it can be very difficult because your portfolio looks so different at different times. And you just have to understand why you're doing it, and all of us have this tendency to try to judge the fundamentals of what's going on. And like that can be a challenge because you're seeing completely different stocks at completely different times in a momentum portfolio. And that's true of, like you said, I mean, the consensus method might, dampen that a little bit, but it's true across all of it, no matter how you were doing it. Even if you're using the consensus method, if I was looking for stocks that simultaneously have value and momentum, there was a point where that would have been value stocks. And so I would have been getting really, really cheap stocks that have a lot of momentum for a period of time. And there was another period of time where my high momentum stocks were not going to be cheap. And it just rotates all over the place.
Do you guys ever have tweets decked up and then don't tweet them?
I mean, I'm so bad at Twitter. I don't know how to have basically I just send out videos at this point, and that's about it.
I probably throughout the day, I probably have I don't know. I'm not great on Twitter either, but I probably have 3 to 5 tweet ideas. And yesterday I had one of them, and I charted. I was because I mean, this relates to this, by the way. So let me just shake it out. I was I was looking at the performance of the Mag 7 over the last month versus like the Russell 2000, so small cap, Russell 2000 value. And like, so I did this, I was charting them all and I had this tweet all decked up and I'm just like, I'm like, is anyone even interested in this? Because I mean, of course you can rewind the clock to the last 3 months or year to date. And obviously the Mag 7 has crushed, the Russell 2000 value. But the point is, and over the last month, the Russell 2000, what I was going to tweet was the Russell 2000 value over the last month is up 14% versus the Mag 7. That's basically like kind of flat when you look at the returns of those 7 stocks. So, but my point in saying this is not that I'm crappy on Twitter, but
it's that you're calling the bottom in value, right?
Well, yeah, I will go. I'm great at calling the bottom. Go read my articles. No, I just, it's, there's a point where the momentum really starts to sniff out these turning points in the market. And, the strength in small caps, particularly value, has been very, very strong over the last month and a half. And so who knows what's going to happen in the future, but, if it continues, momentum strategy will start to bring you into some of those stocks, which by the way, are still kind of relatively cheap, based on traditional value metrics.
I think this is a good time to invoke the Limp Bizkit again, because I think it's that mix and the poetry of, I wrote it down here somewhere because I'm very proud to say I've not committed any of this to memory. Chocolate Starfish and the Hot Dog Flavored Water, the third album from this group. And I think like in the consensus strategy and in the mix to that point, it's this idea of, first off, it was a bad idea that got carried on too long by the group. It was a bad idea to start with, but it got carried on too long. But this idea of like the chocolate starfish and the hot dog flavored water is like, you gotta have the chocolate, you gotta have the good part. I'm going to leave starfish alone and just say it's part of a healthy process. And that's the verifying that it didn't die. That's like your quality factor in there. And then nobody wants the hot dog flavored water. That's always going to be value. It's part of the thing that gets you there, but it's just boring and gross. But when you mix those 3 things together, when you're looking for momentum or what actually matters, when you have some type of like quality overlay in the mix to make sure you don't go to zero. And then when you have something that's like, this is verifiable quality in this is how I don't even want to say the sausage gets made. This is how the Limp Bizkit releases another album. Like it's important to see all these things and be aware of them. So even if that's in your Twitter stack of what's going to go out during the day and you phase this in and out, sometimes you just have to take a shot. And just like the Mag 7 idea and whatever in that tweet that you were talking about, like another really important artifact of momentum is it tells us stuff that worked really well at one point in a time. And how often do we look at like former momentum darlings and do they become value stocks like years later? Look at everything from the tech bubble and then like what we were looking at just a few short years ago. And certainly at the beginning of COVID. And it's just like, oh, wait, maybe this Amazon is onto something, or Tesla or Nvidia or whatever else has come out of the other side of this. So that's me basically saying like, this is so important. It's so important in context. And it's so important to apply broadly, whether you're looking at it in your tweets and what's lined up on the deck, or you're looking at it in music and ideas that, inevitably will blow up and die, but are just taking advantage of prevailing trends of the moment.
I think we can say Limp Bizkit's momentum has come to an end.
But the Limp Bizkit value factor is alive.
Yeah, it's very cheap now, right?
It is cheap now. And all right, I'll derail us for one more second on this stuff. It is cheap now because, and to the degree that you guys are up on your hyperpop, have either of you ever been subjected to 100 gex? Have you successfully avoided this? Probably.
Yeah, I do not know what that is.
Okay. 100 gex is probably one of my favorite pop groups of the last few years. And they fall into this hyperpop category. Absolutely fascinating. But their album that they put out this year it's almost like, it's like a momentum graveyard, but for music. So they're doing like Limp Bizkit quality, like weird metal in songs. They're doing like ska. They're doing all this stuff that is like weird things that like flare into the public conscience and then just flame out horribly to be long forgotten. And they're mashing stuff together. So momentum becomes cheap over time, and then that stuff can get recycled. And we're in this weird wave of resurgence for that stuff right now, under your noses. Somehow, some way, that 100 gex album is on a bunch of critics lists this year. But All I'm saying is, momentum comes back as value, and it's sneaky.
Well, I want to say, we'll get into these other last 2 points, but to kind of, I think, piggyback on your point, Matt, and I'm
Did I
interested
have
in
a
your,
point?
you
Let's be
did,
clear.
because, well, yeah, I think you did, at least.
Okay.
And I'm more interested in both your perspectives on this. I think one thing that happens in the market is, I've always thought, like, investors get callous to both good and bad news. So, if something really good happens, there's a narrative, there's a lot of excitement, there's a lot of enthusiasm. Investors pile in. If something bad happens, investors panic, think the worst, and basically, make moves to adjust to that. But then over time, the behavior, they become used to whatever the narrative, good or bad, is. And so I think that is something that I personally think that happens in the markets, that happens with investors. We become aware of something, our emotions are heightened, and then over time, the information gets digested. Investors may or may not make adjustments to their portfolio, and then they kind of move on to the next thing. And so that may be one of the reasons why momentum tends to maybe work, but it's also, like, behaviorally in the markets, I think we just become more conditioned to good and bad news. And so whatever that news is becomes a little bit less important in the markets, and then the markets move on to the next thing. And that I'm trying to relate that, Matt, back to kind of the point that you were making. I don't know what you guys think of that.
Well, if you think about CPI, like for the first part of my career, I never paid attention to CPI at all. It became like the most important thing of all time for a while, like CPI reports. And now we're getting conditioned to basically not care a lot less about these CPI things as it goes through. So yeah, I think that's right. I mean, something becomes like the thing that everybody is focused on. I'm sure it could be companies, it can be concepts like that, it can be anything. And then suddenly, it's going to wane off again, and we're going to be paying attention to something else.
Yeah, I think this weighs into a lot of Jack, or doing the breaking news podcast stuff too. And this is why you have to see this stuff in layers. I think this is the most important part of this lesson, is you look at the ideas that are becoming the most emergent, and then you want to unpack kind of like the crowd psychology around these ideas and say, like, why are these resonating? And then to connect it back, I think, Justin, this is the point you're making, which I think it's actually a brilliant insight. As you look at the full stack of, like, all these narratives that are on top of each other that are driving narrative and driving price forward, you can start to watch them, like, one at a time, probably, like, tick off as that thing is breaking. So as people lose the faith in various levels, like, of a story, and that's where we see it go down the other side. It's really interesting to think about it that way. And, like, if I pick on CPI from Jack, from your example, like, why did nobody care about CPI? Because there wasn't really inflation by the common terms of measurement that were used as the common terms of measurement for that period of time. So the number didn't move, the metrics and the measurement statistics didn't move, and the government, outside of the Fed, like, who was really talking about inflation for all those years? But then all that starts to change, and it's not just, so does that mean, like, shadow stats were, like, the inflation value investors? Who was that inflation site that used to, or probably still tracks, like, this is the true inflation?
Trueflation, right?
There you go.
Yeah.
Maybe. That's how much attention I paid.
I'm sure their traffic is up like 1,000-fold over whatever it was, if it even existed before all this whole thing.
Who knows? But the point is, like, there's always somebody, or if something has quality, it has this durability thing. It has the starfish factor. And in the starfish factor, something just won't go away. It just won't die. And that narrative exists. But it doesn't have inflation until we have several layers of story, price, some numbers, whatever else, all stacked up. And I guess that's the observation, Justin, that I really like that framing of it, because it's really useful, because it reminds you, even when everybody is just talking about price, there's a whole ecosystem of stuff around that price that's worth understanding, because that's probably how you start to spot the cracks and understand that nothing is permanent.
Yeah, like, one of the things that I know you guys have talked about this on breaking news, so, but, like, the wars that are going on, like, one of the things when Russia invaded Ukraine, you had the idea that, energy levels were going to be super high, and they still are in some areas of the world with, the UK and stuff like that. But like the price of oil has come, way down. And yet, Russia and Ukraine are still at war, and that Russian oil is off the world supply. Now, I don't know. I can't tell you all the dynamics that go into that. But my point is the market and investors have become callous to that to some extent. And so they've moved on beyond worrying about that in terms of the price of oil. That's all I'm saying, not necessarily the war per se, but even that to some extent with headlines and stuff. So I don't know. It's just, that all kind of plays into investor behavior and emotions and stuff. So,
and that's especially relevant in the financial planning conversations too. Like that's why talking about stuff like momentum and unpacking the statistics behind it matters, because whether it's your trajectory in a career, you got a bonus 3 years in a row or something, and now all of a sudden this year the Christmas bonus isn't coming in. Extra Clark Griswold vibes, right? Like stuff can get ugly, and we have to understand where those trends are and what those undermining things can break, because that's part of the financial planning process. Is we as humans will extrapolate these trends into the future indefinitely, if not checked with the statistical realities of more things can happen than will happen.
And to tie it back to like value investors too, like all that stuff you talked about, like this is one of the reasons momentum is great for like a value investor, for any investor to use, is like trying to figure all that stuff out. Good luck with that. But momentum, all it cares about is what's the price action. Like the price action, the market is very efficient. There's a lot of smart people there. What's the price action that's being generated? I'm going to use that price action to make decisions about what I'm doing. And it avoids having to sit there and analyze those types of things, which, at least for me, I'm certainly not smart enough to figure out what's going on with those. So I like that. And I think it's good for like value investors and all types of investors to use momentum because of that. I think it can be really beneficial.
Every CMT is rejoicing and jumping up and down, giving us thumbs up right now for this. And let's talk about it for a second too. I'm curious with you guys, like even if momentum is not a core part of like the top level investment process, when we start to look cross asset class, it's there. And it's there in the most simplest psychological form of, if you look at an account statement and you're like, why is this fund or stock or whatever I own that's like perpetually sucking? Like that's an awareness of momentum. And it's there in both directions, I guess is my point. So like, how do you think about momentum kind of cross asset class in a portfolio? I'm just curious.
Yeah, well, I mean, it works there as well. And, we have some strategies we run that do that, that effectively try to, use momentum. You use both parts of momentum. So use time series momentum to determine like, should I even be invested at all? And then use cross-sectional momentum to say, which asset classes have the most momentum. And, that's been proven out as well. I mean, it works well there too. So it can certainly be used, as an asset allocation strategy as well. And it's subject to all the stuff Justin said before. Obviously, there's going to be the crashes, there's going to be the turning points where it doesn't work, but over time, yeah, I mean, it works there as well.
Yeah, those strategies are, trying to get you in the areas of the market that are working, but then they also have this ability to kind of move out of risk assets when sort of the trend breaks down technically in the majority of them. So the idea is that if, most of them, the majority are exhibiting negative momentum or in a downtrend, there's something wrong in the overall market. And so you want to be moving to more of a risk off type of posture.
I know it's not the point, but just say why it's not the ultimate silver bullet for a second. One of you just point this out again, like especially cross asset class. Why does this just always moving to the thing that's working? Why again does that not solve all the world's problems and isn't the only thing you should ever do forever and always?
Well, first of all, you have to worry about what time frame it's working over. So, if it's working over 14 years or something, like eventually, when you get periods beyond a year, momentum starts to break down. So you can't just, you do have to keep moving to what's working. You can't just say, I'm going to use, you have to be cognizant of the periods over which it works. But also to Justin's point, like it's subject to problems, and it doesn't always work. There's years where there's 3-year periods where it doesn't work. So like anything in investing, like if it works well over the long term, you're probably going to have periods where it doesn't work. You're going to be challenged. You're going to have to believe in it. All that stuff is true of momentum, no matter how you use it. Just like it's true of anything else like value.
Because we use and it's one of the ways you can express momentum in terms of a timing strategy. You can have like a timing system that tries to move in and out of stocks. And we've been running one for a number of years. And I, know the pluses and minuses of it. One of the big minuses that can happen is, and I'm just talking about on equities now. So if you're overlaying something like moving in and out of the market using some type of timing overlay that, is utilizing momentum or trend following, a big downside of it is, and if you think about since the financial crisis, including the 2020 COVID crash, basically every 20% decline in the S&P has been, a turning point. Those 20% declines really haven't turned into full-fledged 35, 45% real bad bear markets. The COVID crash, the S&P was down 30%, but that basically came in like a waterfall shed moment within, 30 to 45 days. So the point is when you're utilizing momentum on top of a investment strategy that is moving in and out of something, whether it's equities or something else, there's always this susceptibility of getting whipsawed. And, over time that can significantly detract from returns versus buy and hold. When it works, when that 20% decline actually turns into something like a 50% decline, like you've had in the financial crisis. Okay, that comes around maybe once every 10 or 20 years based on the historical data. So I think when you're utilizing momentum in that way, there's certainly there can be a big drag on returns by that whipsawing effect.
Yeah, no, I think that's definitely true. Just no matter how you use momentum, there's always going to be these downsides, and that's true of anything. It's not something that's like a knock against momentum because it's true of pretty much anything.
I think we've hit on maybe some of these, but we had a few other points as to ways that, momentum might be utilized. And we kind of talked about, to some extent, entry and exit points. I don't know, Jack, do you have anything else that you want to add to that?
Yeah, well, that gets at Matt's point about momentum can be used on both sides. So it's not just, you have to look for positive momentum, but you also can look for the lack of momentum or really, really bad momentum. And that's a way, like if you look at DFA and the way they run their value strategies, they're not a huge believer in momentum, but they do use it in that way. Like they're not a believer in building momentum portfolios, using momentum as the primary factor, but they do use it to say, all right, if I've got a bunch of cheap stocks that I could buy and they've got pretty similar value profiles, but like some of them are just in free fall and some of them aren't, maybe if I don't buy the ones that are in free fall, that's a better portfolio. Or if on the other side, if like my value stocks, are starting to get more expensive and I got to figure out what to sell, well, maybe the one that continues to have momentum, let's let that one run a little bit. Let's maybe let it go a little bit past what we think our our breaking point on our value criteria would be. Let's continue to hold it. So that whole idea of entry and exit is a really good way for value investors to use momentum where your primary criteria is still value, but around the edges, you're making your portfolio better.
I want to set the last point up with something I remember. I think it was Ben Inker from GMO said when we asked him, I believe it was what question would you teach your average investor? But he was always like, ask yourself why someone would be willing to buy or sell you the stock that you're trading. Because if you're buying the stock, that means someone's willing to sell it to you. Or if you're selling a stock, that means someone's willing to buy it for you. So there's always someone on the other side of that trade. And the chances are they could be a lot smarter than any one of us are in terms of making that decision. But I think with momentum, the thing that investors might want to think about, and I think it's particularly for value investors, if you have something you're looking at that has high momentum, you can, and maybe it's not as cheap as you like. It's like, what am I missing here? What am I missing in the story, either in the numbers, in the outlook that I'm not seeing that the market's seeing? And the same is true for the other side of it. If you have something with very low momentum and you're like, wow, this stock has a PE of 4 and a price to book of 0.3 and, a relative strength of 5. Well, yeah, that's cheap, but what am I missing here? That, maybe there is some huge lawsuit or problems or liability that, investors know about. And we know that investors do have a tendency to overreact to that stuff, but a lot of that stuff can stay cheap for a very long time. So I just think like looking at momentum and asking yourself, what am I missing here is important for all investors.
Yeah, this is like a whole other episode we could do, but this idea of avoiding value traps is something that value investors like always want to do. And it can't be done. I mean, if you're buying a bunch of cheap stocks, you're going to have some value traps in your portfolio. And, when we've done a different episode on our value trap system, but the idea for us, is when we're trying to avoid value traps, we say, all right, we're relying on past fundamentals to buy value stocks. Typically, we're typically relying on, whatever ratio it is, it's something that was reported in the past. Well, what could have happened where those numbers are not reliable? And so we have a bunch of fundamental things we do to say, all right, if this is true, then those numbers might not be that reliable. But the catch-all we use at the end is this idea of momentum. Because to your point, if we think we've got all these great numbers and everything's perfect and the relative strength is 1, 99% of other stocks are outperforming this stock, something has gone wrong here and we're missing something. And so, if we can do that, have a system which just filters those types of stocks out and invests in companies that probably have not that much higher valuations that are still cheap, that makes our system better. Because typically in those stocks that have, say, 3, 4, 5, 10 relative strength, whatever it is, typically in those stocks are some major problems and some stocks that may not make it, some stocks that are going to go bankrupt. And so by avoiding those, that's another way value investors can use momentum, is to use this idea of negative screening to say, all right, I've got my value stocks, but I'm just going to take the absolute worst momentum stuff and I'm just going to chop that off because I know there's probably some major issues there and that might, over time slightly enhance my returns.
I love the idea of this and how it ties back to you can't talk about markets without talking about marketing. Because now in those stacks, the way you're explaining it right there, both of you, is the more extreme the story in either direction, the more extreme the sales pitch needs to be to buy or sell. Because I could have the thing that's the worst momentum ever in the complete basement, and I have the holder-oners and whether or not they're going to sell, if ever, but then also the pitch on no one likes this thing. No one new will touch it because it just keeps going down. What value pitch do I need to give you to make you just believe this thing isn't going to zero? And the flip side, you have the most extreme positive momentum and having to find somebody who's oh no, this thing is only going up. And whether that's Bitcoin or real estate or tech stocks or oil stocks, 6 months ago when they were doing good, whatever it is you can't talk about markets without talking about marketing. And the more extreme the momentum, the more extreme the sales pitch you need to get that transaction done. That's a really, really powerful point.
So we're 1 or 2 podcasts away from the end of the year. If people don't happen to catch the last one, we wish everyone that's watching a happy and healthy and safe holiday season. But try to tune in next week because that will be our 2024 predictions. And we're all coming to the table with our horrible forecasting abilities, but we're going to give it a shot anyways. And hopefully, help people learn along the way with us. So we appreciate everyone from watching and we'll see you guys next time.
Hi guys, this is Justin again. Thanks so much for tuning into this episode. You can follow Jack on Twitter at @PracticalQuant. You can follow me on Twitter at JJCarbonneau and follow Matt on Twitter at @CultishCreative. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. Also, if you have any ideas for topics you'd like us to cover in the future, please email us at excessreturnspod@gmail.com. We would like this to be a listener-driven podcast and would appreciate any suggestions. Thank you.